says we're live.
It
What's up,
says we're
Nathan?
live. I don't know. So,
Introduce
sir.
yourself.
Hey, yeah. So my name is Nathan Tschappler. I'm a mortgage guy. That's just really what I do all day, every day. And we've talked to Corey quite a bit, other people in the groups. Usually, we're kind of just trolling people, but sometimes we try to provide answers for people. And if I'm not the right fit, then I try to find somebody else and tell them, hey, you guys should go and talk to this person to get your specific deal done. So anyway.
There was somebody the other day, and I don't remember what it was regarding, but basically you told them to go find more information, and they called you an asshole, and I was like, what?
I was kind of like at a kind of a I was a little bit stressed out that day for sure. And no, the big thing that was about like the telephone calls or whatever. And so, that's just kind of my interpretation of what I've heard of the law, but I don't really want to be giving like legal advice on Facebook. So that's really why I was just telling people, hey, just go read it for yourself. You know what I mean? Like, I'm not here to make your legal decisions for you about what you want to do,
I had a guy message me a long time ago. I'm trying to think of his name, but it don't matter. And I told him that he might be my first affiliate link if his product did whatever he said it would do. And then I never looked into his product, so I never did get an affiliate link because I just always was like, I don't care about affiliate links. Then I found out Max Maxwell makes like $250,000 a month on affiliate links, and I was like, it might have been something there. If I'd have timed that market right, could I have been the affiliate link guru? But I couldn't, so I didn't, and that's just it. Hindsight's 2020. But this particular dude, he attacked me in his own Facebook group, and that he had tried to add me to. Mm-hmm. So, like, I seen it, but I couldn't comment on it because I wasn't in the group because I'd just been invited. So I had to accept his invite to his group so he could roast me, and it was in the comment section, but basically said that I was unethical for, that I told him at some point in time that I would be his first affiliate link, and that I was unethical for telling people how to do marketing that's illegal. I thought to myself, I'm like Mr. Motherfucking Bandit sign. You know what I mean? Like,
right.
But whatever.
Yeah.
But now I think about it, and I think that the more people know your name, the more exposure you're going to have. Because I've got a lawsuit right here. The more exposure you're going to have to bullshit, and so
right.
Is it really worth the bullshit to give something to people that for a value way under what it's worth, just because you want to help people be more successful when they don't even take action on it on their own? It's like. So I really have underwrote that a lot in the last probably 45 days. I'm supposed to be in Amarillo tomorrow. Coronavirus has me canceled out of Amarillo. I'm not going up there during this environment. But, to teach this class, and I do appreciate everybody that came out and supported that wholeheartedly. But there's a ton of risk involved in that for me that I know about now that I didn't know about then. And so I probably won't teach that class for $100. It'll probably take me several thousand to teach that class because, giving it to everybody, every Tom, Dick, and Harry that has $100 probably isn't the best idea in the world. Probably, but I don't know. You know what I mean? I'm always rooting for the underdog. So, Nathan, you made a post. You're talking about what the Fed is doing right now with this $1.5 trillion.
Yeah, so and this is just kind of my layperson understanding for it. And maybe if you wanted to go more in depth, you might be able to research other people. But honestly, like I've tried to like find people that really understand the Federal Reserve and everything. And this is just kind of side note, but dude, a lot of people don't know, and they're just kind of like making stuff up, like, oh, I think this is going to whatever. But the kind of like the simplest, if you're going to get it down to the nuts and bolts, is it's not quantitative easing. It's not really doing anything. But what happens is the banks, they all have reserve requirements, right? They all have to keep cash on hand, certain amount. Dodd-Frank back in like 2010 actually increased a lot of those requirements and everything because what they have to do is, instead of just the reserve requirements, they also have to be stress testing themselves for like a worst case scenario, and they also have to have additional reserves to meet those stress tests, kind of, right? Again, I'm not an expert. That's just kind of like the rough understanding I have of that. So what happens is every single night, right, the banks are going to lend money to each other. And so it'd be something where like the bank is kind of like looking at all their numbers. They're like, oh crap, we're going to be short like $1 billion tonight. We need to borrow money, right? So they go out on the street and they'd be looking around for cash, and they just talk to all the other banks like, hey man, can I just borrow the cash I need for tonight, right? And so anyway, they were definitely having some concerns that there wouldn't really be cash for the banks to borrow to meet like what they would need for their liquid cash to remove. Like if you walk into the bank and you want to if you want to withdraw the cash, they also need that. They also need the cash reserves, and then they also need to comply with Dodd-Frank and all their stress testing, right? And so the Fed was kind of worried that they were going to run into issues with that liquidity issue of the banks not being able to borrow money. So what the Federal Reserve said was, hey, what we're going to do is we're going to inject $1.5 trillion. We're not going to give it to you. What we're going to do is we're going to use that to buy up different assets that the banks own, like 10-year treasury notes. Like that's the biggest one. Pretty much all the treasury notes that they have. So basically the Federal Reserve will then just trade. They'll pay cash to the banks, and then the Federal Reserve will get the asset of kind of like that bond, right? So then all of a sudden the bank has like $1 billion of cash, and then, oh, like if they need to lend money to the other bank next door, if, you know, whatever. So it's basically just adding liquidity into that marketplace, so then the banks can have the cash that they need for all that stuff to keep going. So it's not really like quantitative easing necessarily. Like it's just kind of adding some liquidity to all the banks as they're looking at all this stuff. And
so my question is, and this might be above all of our pay grade, is in an instance where the stock market's having a sell-off. So the stock market is completely fucking selling it. There's trillions of dollars in the stock market. I don't even know what the total market cap is, but whatever it is, that money's in the stock market. When it leaves the stock market, it doesn't disappear. It just goes someplace else. You know, it goes into bonds. That's why the bonds are tanking. Goes in, like some people just sideline it into their Fidelity account. So it's just sitting on the sidelines. So when they think it gets to the bottom, they can buy back in and ride it back up. Go somewhere. Isn't the money already in the bank? You know what I mean? It's just like, you know what I mean? Like whenever I think about it, and maybe I'm thinking about it wrong, but it's like, if I've got X number of dollars in the bank, it doesn't matter how many dollars are in the bank. Okay. And maybe I'm going to erase all this. I think Spoon got a picture of it, but this is where it gets really fucking confusing for anybody. And I wish I had some stock guy that could come on and explain stocks a lot better to me. I reached out to maybe Marshall will want to. So if I have $100, whoops, I have $100, and that's all the fuck I got is that $100, and it's in the stock market, and I decide, oh no, I want my $100 back. I don't want $100 worth of, you know, fucking Alienware stock. I want $100. So I sell it. The money was in, I guess, Alienware's account. I don't know whose account it was in, but it was in a bank account, and it just goes into another bank account, right or wrong. Like the money just is always in a bank. It's always in a bank. So whenever things like this happen, and the banks start talking about liquidity, I can't help but feel like it's specific banks that need help, not necessarily the entire banking industry. Because if you look at what Boeing just did, did you see what Boeing did?
I didn't get a chance to see that.
So Boeing 2 days ago, they had a $13.8 billion line of credit. So I got a line of credit. I don't know how much they had on it, but they drew down the entire $13.8 billion because they didn't trust the banks would be liquid enough in their time of need. So they felt like if everything kept going the same way that it was going, that whenever they needed money, they wouldn't have it. So they just drew it down and started paying interest on it. So now the money's in their bank account. It's out of the bank's bank account into into Boeing's bank account so they can use it to navigate these tough times, which might be to pay dividends, whatever. I don't know what they can use that money for, but whatever they can use it for, to fund operations, to keep the payroll account open, whatever it was. And
you have to remember there's one other variable. It's not just cash flowing around inside the economy. It's also credit. And credit is like a way bigger portion of everything kind of flowing around than cash is at any particular time. So, and I think it's something crazy, like, I don't know, maybe even like 50 times more credit like flowing around between people. So like you and I, and I was just reminded of this. Ray Dalio, he has a video where he talks about like basic principles of the economy. And it's really excellent. It's about 30 minutes long, but he kind of explains how all the transactions work. So like if you give me a product and then I say, hey, I promise to pay you, then basically we've just created credit, right?
Mm-hmm.
So then that's going to be an asset to you. It's going to be a liability to me until we settle it, right?
Mm-hmm.
And whether I have cash or not, that's where I would start running into liquidity issues, right? Where if I have a lot of IOU notes out there and I also have assets on my books, then maybe people don't want to buy those assets from me, right? Because you gave me a product, which is going to be an asset or something, like let's say a bond, right?
Mm-hmm.
Like you give me a bond, I give you an IOU and say, hey man, I promise I'm going to pay this to you at some point in the future. You're like, that's cool, man. So,
but that's where I think the liquidity issues come in, because now I've got a liquidity issue. I've got your IOU, so I go borrow money against the IOU.
What if nobody wants to lend, right?
But they did want to lend a few months ago.
Okay.
Now they've loaned out on the IOUs, right?
Right.
And the IOUs aren't worth as much anymore. And so they're like, hey, I need you to pay me back that money I gave you on the IOU. Now we have the liquidity crunch. In my mind, that's how it looks. Okay.
Right.
And I don't even know if I could properly diagram this with my $100 to $100 graph. But to me, what happened, where the liquidity comes from is, and banks do it. I know that our small town bank does. And I know it because I knew the guy that was in charge of actually buying the stocks. So they would take money that they have in the bank. So let's say they've made, I don't know, car loans. You know what I mean? So they've got all these 8% interest car loans that they've loaned out, and Corey's paying on his 8% car loan, but they don't necessarily feel comfortable about it, right? So they're like, I think Corey's going to keep paying on his car loan, but I think I've got some exposure there, and I want to hedge that exposure. So they go to the stock market, and they hedge in the stock market with X number of dollars that's going to pay them dividends and give them a return, okay, in case they end up having to take some of these car back. And that's a very rudimentary discovery, right.
Whatever.
But, or they sold bank shares. They sold bank shares, and they took that money and they put it in the stock market to hedge against, any local disturbance in a local economy, right? So the local economy can be brought down by a factory moving out of town. You know what I mean? And all of a sudden now the bank's got exposure in the local economy. So they hedge in the global economy by buying stocks, bonds, dividends, whatever it is. And so his job was somewhat to find that for them to invest in. When they do that, right, that's an asset. It's like, oh, I bought at $1, now it's worth $5. We're good. We can loan more money. We can take on more local exposure. So they loan more money. And then all of a sudden the crash happens. Now it's worth, $4, but I've loaned out on my assets, which was, stocks that were worth $5. Now those stocks are only worth $4. Somebody's got to pay the piper. So there's a margin call, and, it creates a liquidity crunch because now the bank has to write a check to somebody. That's what I see happening. Did I make any sense in that incoherent rambling of what I think is going on the backside of banking? That could be.
Yeah, that definitely makes sense. I don't know personally whether they use stocks to keep their reserves up or whatever, but that definitely makes sense. Like that does, and it's all kind of, there's, the economy is going great, until all of a sudden we hit like the X factor, which is going to be basically, oh crap, like, so travel, hospitality, that's like 15% of our GDP, right? All of a sudden that's cut to like zero, for at least 2 or 3 months. And we don't even know really, and all those like supporting jobs for that, right? And then like the oil field, like you've been talking about that, like everyone's like they're losing their shirts right now because they can't sell their oil. So we're hitting like the X factor, and the stock market is trying to figure out what the future is going to look like. Here's the one thing that does really concern me, right? Is that basically and maybe I'm not smart enough to understand like why this isn't a problem, but basically for the last 10 years, companies have been using debt, right? Like they've been issuing a crap ton of super cheap debt, right?
Mhm.
Where they've used a lot of that debt to buy back their shares, right? So basically they take on debt and then they buy their existing equities with it, right? And then all of a sudden their stock price goes up because their multiple of like the outstanding shares they have divided by what their company is worth, and maybe I'm even describing that wrong. The equities go up, right? So it's kind of like all of a sudden, like what if they start defaulting on that debt that they have issued? All of a sudden, if they have a balloon payment coming up, they have to reissue new bonds or whatever, then they can't do that. Nobody's going to buy that debt from them. So all of a sudden they start running into issues. And the only asset that they really bought was just their equity back. So then all of a sudden what are they going to do? Like, oh, let's go issue new stocks again, right? Well, crap, like nobody really wants to be buying, then it's kind of like what's going on. So
well, that part of it, I guess regulation is always needed, but there's always something that's overlooked. That's part of it that I don't understand either, because it's a vicious cycle that during times like this, I mean, hell, for all I know, Boeing took $13.8 billion to buy their own dip. You know what I mean?
Mhm.
Like, fuck, what are we gonna do? Well, our stock ain't worth shit now. Give it 2 months, it'll be worth double, and we can buy $13.8 billion worth of our stock back, and
Yeah.
then when it's worth double, sell it. I don't know what the overall plan is there, and I don't know how, but it seems like a very, very vicious way for everything to work from just from a financial point of view. So like when I look at it, I last year, this is way off topic, but last year for whatever reason, onions sold for a shitload. I know that because one of our lenders is an onion farmer, and so he made a shit ton of money in onions, and then he had to replant them. He had to replant it to be able to avoid this big tax, right? So he loaned us $900,000, but he had to have it back so he could take that $900,000, buy more onions, put them in the ground, because I guess onions don't have a seed. I don't know how onions work, but he had to put more onions in the ground, or he would have had to pay $450,000 worth of income tax. So we got him his money back. So we refinanced his money back out. He replants his onions, and now he's going to loan us $900,000 back when he gets it back. The loan is set to close on the 20th of this month. Okay. So it's like, okay, what's he doing on the backside of that? So he's planting the onions. He had to pay the money to plant the onions. He had to buy the onions to plant. He had to pay the farmers or ranchers or whoever to plow the field. There was costs that left his bank. Is he then leveraging against his future onion crop, right? To get the money back out of the ground and then loaning that money back to us. And that very, like, I don't know if it's macro or micro example of how money moves around weirdly, is kind of like what's got me uneasy, because if I've got a lender that's relying on credit lines from banks that we talked about before we turned this on,
right.
They get a credit line from a bank at 5% interest, and they loan it to me at 12% interest. That's a really good relationship. You know what I mean? I've got the hard asset that produces the cash flow. The tenants pay the rent. We service the debt. We make a margin. Our lender makes a margin. The bank gets their 5%, right? But on the backside of the bank, if the bank sold that debt on Wall Street, you know what I mean? And now there's a margin call involved of some sort where the bank now needs the money back. It's this domino effect of where, okay, I've I leverage my notes, okay, also own stock, and now somebody's asking me for money because there's a margin call because all of a sudden the stocks are worth less. I need money. Hey, bro, Mr. Lender, I need you've got a credit line with me. I need it back. Our lender comes to us and says, hey, our lender needs the money back. You know what I mean? So I need my money back. Like I need my money back so I can pay off my credit line. And we're sitting in a situation where we own a hard asset and we're like, well, fuck, we get our money $9,000 a month at a time. And we give you cocksuckers fucking 5,000 of it right off the top. You know what I mean? So we're not really making a shit ton of money on this. And now you just want the money back? Well, we got to go ask another lender. Well, if every lender's in that same situation, where's the money come from? You know what I mean? Where did the money go? Where, how do people even make moves or navigate in an economy like this whenever there's so much uncertainty? And everybody, if you went, like right now, people are coming to you for loans. No underwriting has changed at all on the loan process, right? You can still make a loan. You still have a bottomless bucket of money to loan out, correct?
Yep.
And nobody's saying anything about it.
No. About like what?
About hey, let's pause for a minute, not make as many loans because there's liquidity issues.
So the only reason that changes is going to be the mortgage backed security, the secondary market, right? So, and that changed, like it went up by 100 basis points yesterday for like 18 minutes, and then went back down by 100 basis points, and that was right around when the Fed announced. And it's been a super weird market for like the past week, maybe week and a half, 2 weeks. Monday morning for like 2 hours, we probably had like the best pricing ever. And then after that, it's been constantly repricing worse. But historically, the mortgage-backed security market, which dictates the interest rates that people get for all of their agency loans, which is going to be conventional loans, FHA, VA loans, they typically follow kind of like what the 10-year treasury yield is going to be. And that's, I think, and I'm getting a little bit deep into like the secondary market, but basically everything is going to be like a floating rate interest on it until we sell the loan to the investor that sells it to Fannie Mae or whatever, right? Or we can sell to Fannie Mae, Freddie Mac. So everything is floating. But what happens is kind of like what you just said, is as soon as we lock in the interest rate for the client, basically the company assumes the risk of the pricing changing between when we close the loan, the client signs for it, and the date that we locked it in, and then the date that we end up selling it to Fannie Mae. So what happened was, and we do all this stuff on like margin calls, right? But basically we would just hedge the opposite direction, right? So if we're going to hedge that interest rates are going to start going up, so by the time we deliver it, we're going to get paid way less than what we locked the loan in for. Well, we're going to lose a ton of money with that. So what we have to do is we have to hedge in like the opposite direction, right? So if rates end up going down before we deliver the loan, we'll make a little bit more profit on the loan, but we also assume the risk and the liability if the rates go up. And so the consumer doesn't know, they don't really care. They're like, whatever, it's fine. So what happened was Monday morning, and all of last week, basically, and the week before that, we had pretty low interest rates. Tuesday morning, things went up like crazy. So what happens is then all of the locks that we had hedged in, and all of us loan officers were super productive. We locked in a ton of refinances. We had enormous volume, right, that we shoved out. And so then Tuesday morning, a lot of the mortgage companies, they got phone calls from their people where they placed their hedges with, right? And those people were like, hey, so yeah, all those hedges that you have on margin with us right now, we need to have like a margin call with this because the rates went up like crazy. The secondary market moved a ton and you guys haven't delivered the mortgages yet, right? So then some of the companies even got hit. Like they were like, hey, you guys have to write a check for $140 million right now, like on loans that you're going to produce into the future, right? And so you haven't gotten paid on those yet. But if you want us to protect your future income, you have to cut us this check right now today. Otherwise, we're dropping your hedge. We're just going to sell it off, right? So a lot of the mortgage companies got hit like Tuesday morning, like somebody just gives them a phone call like, hey, man, you're going to have to write this big check. And the company is like, what are they going to do? They have to pay it. So I heard rumors that like, and I'm not going to say who it is, but one mortgage company had to take out a loan to make that payment and everything too. So it kind of it's all just kind of like a cash flow issue with that. So from that aspect of things, just from like operationally, it is important just to make sure that you have kind of those reserves and everything for the mortgage company. But that's not really, that's more of just like on the operation side. As far as like the secondary market goes, where you're selling the mortgages too, it's just been like a weird market. And I was trying to say this before, but I kind of got a little bit sidetracked. But basically, the mortgage rates, they've kind of followed what the 10-year Treasury yield has been historically. Like if you look at a chart, you know, and it's just kind of a correlation. And the biggest differences are going to be when investors are buying the 10-year Treasury, they know guaranteed what income they're going to make over the 10 years. So they can buy it exactly and precisely, right? Like these bond traders are very smart people. When you're buying a mortgage-backed security, you have to guess at what your future income is going to be because there's 5 or 6 risk factors that you have in addition to what the 10-year Treasury has as like a fixed income, right? So your person that has a mortgage could die. They could sell the house. They could refinance the house. They could do, there's like at least one other thing. But basically, your future income from that is going to be cut down if any of those things happen, right? So what they do is they run actuarial tables. They're like, oh, here's what we think the risk is. But the biggest variable is going to be the refinance piece, right? Because we don't know if interest rates are going to be like 1% lower in 6 months. And all of a sudden, like all these people that we're writing mortgages for today, they're going to refinance in 6 months. And then all of a sudden, the bond should have been priced today at a much lower price than if the person is going to keep the loan for the next 10 years, if that makes sense. Mm-hmm. So we've seen like extreme volatility over the past week, and I'm still not really sure. And the yield between like what the 10-year Treasury and like what the mortgage-backed security market has been is like the farthest it's been, at least in like the past 4 years. Like it's super far apart, and I'm not sure like if we're going to see it close sooner. Part of that issue is also just because we were so productive. Loan officers originated a huge amount of mortgages, so there's like a huge supply of mortgages coming in. So the current demand kind of just drives the price up just a little bit. So there's that too. But I don't know if that kind of makes sense. I'm just like rambling at this point.
It makes a little bit of sense, but that's why that's why we had you on, because I have no idea what's going on, and I'm trying to make sense of it. But like the 10-year Treasury curve, I mean, it plummeted too, didn't it?
Yeah, it did.
Fall out of sight because when everybody put their money out of the market, they wanted to put it into bonds. I'm guessing that if they wanted more what's it called, mortgage-backed securities.
Yep.
I mean, there seems to be a ton of volume there they could buy. If they felt like that was a better investment than the stock market. But overall, the liquidity issues that the Fed is trying to help with, the 1.5 trillion. It would be funny to like bubble chart graph out like how Wells Fargo, Bank of America, all the big banks, what their exposure is to the stock market. Like how much stock have they bought with money? How much stock have they sold? Like how many notes? If there's mortgage-backed security, surely people buy car notes. You know what I mean?
Yeah.
People buy debt on jet skis and different things like that. You've got people that originate those notes, but then they get sold on the secondary market. And how much of that, how many of those notes, because we talk about hypothecating money on Roughneck real estate all the time. So if I originate a $40,000 note and then I go borrow $30,000 against it to get $30,000 back into my bank account, so I can go buy another asset to then owner finance and hypothecate more money. That's very small scale, but that's also happening in, you know what I mean? Like they don't just sell notes. Wells Fargo don't just sell them all. They hold some of them and they borrow money against it. And when they borrow money against it, what do they do with the money that they borrow? So this is a very complex issue that when the stock market craters like this, it ripples through. And so me being an investor at the bottom, like the closest to the pain, right? Because we've got tenants that pay rent every single month. they get money. Let's say they work down at the feed store or down at Dollar General or whatever. They get money. They're far removed from Wall Street.
Yeah.
Immediate impact. You know what I mean? Like
Right.
the Groesbeck Dollar General isn't going to have a mass layoff tomorrow because Wall Street went to shit. You know what I mean?
Right.
There's going to be some turmoil at the top. People are going to be stressed the fuck out. But overall, it's going to take a while before, whatever happens, whatever Dollar General survives, makes it all the way to the employee. So that employee that pays us rent is still going to be able to pay rent. The problem is if my bank that has that note has a liquidity issue and comes knocking and says, hey, we need to see a trailing 12 because we want to know, what's going on here. And they call our note due because they have a liquidity issue. Now it's like, we can't pay you off $560,000 right now. You know what I mean? That would bankrupt us. We would have to sell everything we own to be able to do it. There's no buyers in the market because they can't go get a loan anywhere to do it. And now we have to sign you over an asset. And, you get to manage it. You get the girl's money that works at Dollar General every month instead of us. And I don't know if a bank has that kind of appetite right now to take back assets like that. So when you hear people, when you hear the banks buying repos, you're like, what got repoed? What, you know what I mean? What is it that they're supplying liquidity for? Well, it has to be related to stocks. You know what I mean? That there was a margin call on the stock. There was a margin call for the mortgage-backed securities that people had to write a check for $140 million. They didn't have it. And so now the government steps in to help. Somebody said that it's just a short term. You said it at the beginning. You explained it very well at the beginning, and there was nobody watching, but you explained it very well at the beginning. What does that look like? How long before that money has to be paid back, or what, when the stock market bounced back and, does the Fed now own a bunch of stock? Like what is it? What did they buy?
They didn't buy any of the stocks. They just bought other assets. That would be specifically like the 10-year treasuries, other treasuries too, different bonds, financial instruments so it's almost like the government buying back its own bonds from banks and giving them cash for it. And now the government has another asset of itself on the books. The government is not buying mortgage-backed securities with that money, and they're not buying stocks with it.
Okay.
So they're only buying like very specific, and I haven't even looked at kind of like how long they expect to have it on their balance sheets, like those assets that they bought. So I've just been kind of trying to look and see how it would just impact me with mortgages, So
how do you think it's going to impact you?
I mean, as long as people are still buying mortgage-backed securities, if the supply is pretty high and the demand to buy them is low, then interest rates are just going to rise up for people. But we're still going to have funding. The only problem is if nobody ever wants to buy them, then kind of funding would basically shut off. But I don't know if that's even possible or at what point we would ever see that happen, So, but at a certain price, somebody's going to be willing to buy it. That's kind of, and whatever they're bidding for it, then the consumer has to pay a higher interest rate. So, but
that is true. What else from your side of things are you seeing or hearing, rumor wise? I don't know how all of this affects us long term. Obviously, the virus and everything else that's causing this calamity is going to go away. You know what I mean? What do you think is going to happen on the backside?
And I don't even know. I'm not smart enough to know that. You should talk to a couple other guys. You could talk to. Shoot, I have a client calling me. I really need to.
Take it.
Well, he called me before. I'll call him in a second. He called me just like 30 minutes right when I hopped on the live or something.
Okay.
So, but I'll call him back in a second when I get off. But I don't know. You could talk to Chris Mays about some of this stuff too. Do you know him pretty well?
I'll reach out to him on Facebook.
Yeah,
see if he's got some.
Reach out to him and see. He's super smart. He's like talked to me about this stuff. We just message about it, and I'm like, dude, I'm kind of worried. Are you worried? And like we just talk about it, and he knows a lot of stuff about the bond market too, and he could answer all those questions. TJ too. He knows I think he was into the stock market and stuff. Probably knows a lot more than I do. Yeah, I think he was Yeah, he was involved somehow with trading stocks, like a while ago before he got into real estate. But he'd probably know a lot more than I would too. So
I was talking to Marshall Hooper yesterday. Reached out to him. I really think on this side of things, we all try to figure out how it's going to affect us overall. You know what I mean?
Yeah.
And I see some of the hard money lenders kind of have an insight about their business model, like I said, with the credit line and stuff like that. I've reached out to a handful of them and said, "Hey, look, here's the situation. What are you hearing?" And they're like, "Dude, we haven't heard anything from the banks, but we're also not reaching out. We don't expect this to last long. As far as the small community banks go, like the ones that are here in Groesbeck, I don't really know what their exposure to it is overall. I think they're super conservative. So as soon as, any shit hits the fan, they're out. You know what I mean? Like, it's like if they did have money in the stock market, as soon as it dropped 1,000 points, they were out of the stock market. They were, you know what I mean? They caused it to drop further probably because they don't have the ability to weather that storm. You know what I mean? Their note portfolio that they hold in house is with shareholder money and in their own personal deposits. So it probably actually helps them out whenever people get out of the stock market because they're keeping their money at their bank. So now they have more money to loan out or more reserves or whatever it is. So I think overall hard money lenders operate with those small, regional banks. But I don't know because whenever I think about it, go ahead.
What else was Marshall saying specifically? I don't want to forget about when you talked to him yesterday. I wanted to talk to him too.
But I can give you his number. I actually want to see if Marshall wants to get on here because we were both trying to figure out what the liquidity crunch was. Because, if there's margin calls and stuff like that the bank's having to pay, that makes sense that there'd be a liquidity crunch because, if they were leveraged in the stock market, then, obviously there'd be a margin call and they'd have to come up with money and it would cause them some problems. But overall, the $100 to $100 diagram that's over my shoulder, like
right.
Money stays in banks. You know what I mean? No matter where it's sitting in a bank. It's not very few people had a run on the bank where they went and, I don't know anybody that ran up to the bank and was like, "Hey, I got $1 million in there. Like I want it in ones and pennies, like put it in the trunk of my car. I'm out." I don't know that happened. I haven't heard that happened. So I was wondering what is a liquidity crunch?
I've heard, I don't really know much about this, but I think there's also like on some of the corporate debt, there's also, they have like requirements, like if the stock market or the Dow Jones Industrial or S&P 500, if it hits a certain level, then their debt becomes called due or something. I could be wrong about that, but I've heard that there were some triggers for some sorts of stuff. I don't even know, but that could cause, if that's true, and I just heard some people talking about that on Twitter who were like a lot more into.
But that's where my pea brain can't wrap my mind around it. Because if Apple owes $100 billion, whatever, they got $100 billion worth of debt. Their cash on hand is $20 billion. Their stock dips and the banks say, "Hey, we need $100 billion." They're like, "We got 20, but we ain't giving it to you. You can just have our stock." You know what I mean? Like whatever that stock that they had leverage or whatever it is. To me, it's like, well, all right, if I'm a bank, I didn't want to be a stockholder, but now I got this stock. It's going to bounce back. I'm probably going to make money. You know what I mean? Like what overall, why would the Fed need to jump in and dump liquidity in? Because the $20 billion that they had on hand is still in a bank somewhere. You know what I mean? So it's really hard for me to wrap my mind around when the Fed starts pumping money in. What you just explained about them buying their bonds back and buying all that makes absolute perfect sense. You know what I mean? But the need for it, other than margin calls and stuff like that, because I know people that borrow money against their 401k to buy real estate. Okay. There was probably a ton of those loans that they had to bring some money to the table to keep the loan. Otherwise, they lost their 401k. Well, the bank knew that risk when they loaned the money. They got the collateral. You know what I mean? Like what's next? Why do you did your cash situation really change? I mean, I know one bank's cash situation changed because Boeing had to, drew down a $13.8 billion line. So They have a liquidity issue probably, but overall, like it's really hard for me to wrap my mind around what you've explained about them buying stock back or buying bonds back makes perfect sense. It makes my head hurt. I got corona symptoms now because I'm trying to think about it. It's like,
bro, turn this webcam off. I don't want to get infected through the webcam or the screen, man. I don't know.
Dude,
is that how that works? I don't know.
Well, we did send everybody and let them work from home, but that's just so we don't all get sick at once. When you only got 6 people in an office, you can't all be out for the same 30 days. Like somebody's got to be here to do the work. So we figure if we stagger out or how we catch it, we'll be better off. But from real estate investors' point of view, if I'm out wholesaling or I'm out buying houses, what do you have any advice that you would give to somebody in this climate? Call you to get a loan? Is that all you could say? Is like, hey, we still got money to loan. Call me.
What you were saying to that guy too before we even got on the phone call was like really good advice, right? Like you wanted to make sure that you have the cash flow and everything to support it, So as long as they don't call the note due, and really if you're locked in and you sign something, you don't have like balloon payments coming up, then you're probably going to be fine, as long as you don't violate the terms and conditions that would cause it to get called due, But really just making sure that you're not leveraged too heavily. He had a good post about this too, how he was making sure that he had plenty of cash around, It's probably going to put you in a good position to make sure that you can even buy assets if there's a good opportunity here in like 3 or 4 months. Probably gonna be like a very good buying opportunity in a little bit, whether that's stock or real estate or whatever. But yeah,
stocks will be great. So I think there's going to be great buying opportunities for stocks. We might be there right now. I don't know, but real estate, it'll take it such a long time to think about it. If we had to sign over all of our assets to our lenders right now, you know what I mean? They all have tenants in place. They're all cash flowing. We just they all wanted their money back because whatever. And we said, look, we don't got it. Take it all back. We shove it all back to them. How long is it going to be before that's a good deal for somebody to buy? I think they're just going to manage those assets, or hire property management, hang on to those assets. I don't know that they try to liquidate them in this market. And the reason why is because there's already, you know what I mean? Like if everybody floods the market with inventory, it would seem that it would drive the price down, but I don't think that anybody.
It all just depends upon how many, right? So how many flood the market, So
me and Spoon just talked about it on the previous live. Like, hey, what does it look like? What does it look like right now? What's our buying strategy right now? Buying strategy right now, if there's debt on the property, is subject to. We just want to take over your payment. We're not offering you any cash to walk away. Why? Because I feel like there's going to be if there's one of those people calling, there's going to be a ton of those people calling. So I don't have to do anything. I understand that strategy, so that's what I can offer you. I'm not going to offer you any cash because of the same reason the guy I was talking with on the phone before we started this live that you got to hear part of the conversation. That situation there is, hey, I don't know if my lender is going to loan me money in 45 days. Therefore, I'll take over your payment. But I'm going to hold that as a rental. I'm not going to owner finance it. I'm going to hold it as a rental. That's that strategy there. If there's no debt on the property, I'm going to make a very, very savage cash offer because I have to set the expectation for my private money people that we're going to be in this ride together for the next 18 months. I don't know why 18 months is my number. It just seems like a really good number to throw at a private money person to set the expectation. This isn't a 6-month turnaround you're used to. This is an 18-month turnaround that we're looking for. So that private money person either then has to decide, I'm going to loan you money for 18 months or I'm not going to loan you money for 18 months, right? And we all have to like I might want to hold on to that cash for bullets or something. You know what I mean?
Right.
I don't know what they want that cash for. But I might want to keep my powder dry if I have that money, if I'm a private money lender, or I'm willing to loan it to you for 18 months because I want out of this volatility over here. And I think 18 months is a great timeline for me. And I'll do it. So I set that expectation up front. And because I won't have as much access to capital, setting that expectation, I've got to buy at a steeper cash discount. That seller might not be willing to sell it at that big of a discount. So since they're not, I present a terms offer, and terms offers interest only or interest free, 120, 180 day or 120, 180 month. Take it or leave it. Why are we making that? Because if I do believe that there's going to be a shit ton of motivation and blood in the streets, then inventory will not be a problem. That's me. But I think everybody will be in a holding pattern for the short term. I think sellers will be in a holding pattern. I think lenders will be in a holding pattern. Not mortgage lenders, but like hard money, private money people will be in a holding pattern. Yeah. And I think that people with a ton of cash will be in a holding pattern, waiting for that steep price decline to get in on real estate if they've been waiting for that. And I think it will take some time. I don't maybe I'm wrong. You know what I mean? Maybe I'm absolutely wrong. And the price of real estate goes down overnight but I really don't think there's a ton of inventory out there that's just sitting there free and clear. I think a lot of it's leveraged, and because of a lot of it's leveraged, a lot of it might be over leveraged. So short sale, bank repos, it takes a long time for that stuff to work its way through. If you're a short sale, they'll only sell it for 80% of appraised value. Well, appraisals are still high right now, so there's not going to be any deals there. So, I think people that think that are sitting there that have been wanting this, they got it now, but I don't think it's going to have the effect they think it's going to have. I don't think it's like instant, oh man, but I don't know that. I've never been through it.
And really, I think 2008 was hopefully kind of a anomaly as far as it goes with mortgage lending. And really, if rates drop, let's say another 1% lower from what they are right now today, then if you look at the numbers, it should be, as long as people's incomes stay the same as what it is today, then that would increase how much house they could buy. And people that couldn't buy a house right now at current interest rate would be able to afford the payment of a house so basically you increase the demand for houses by 4 or 5 million people. So as long as mortgage lending and people are still buying the mortgage-backed securities and everything, and they're moving their money there for kind of a safe place, then the demand for at least residential houses should be fine. I don't know anything about commercial. I don't want to multi-family, whatever, that could be completely different. And again, I'm just kind of this is just, I'm just kind of talking, and I could be completely wrong. So if somebody that is listening to this is oh, Nathan, you're so wrong about this. And just obviously I want them to comment and just tell me so I can learn, so that's all I'm kind of,
I said that on a previous live. I was anybody that wants to criticize me, by all means, let's do it. I am scouring the internet, looking at Grant Cardone, Gary Vee, Tom Billiall, all these big entrepreneurs, right? Mr. Positivities. We're all so positive. We all want to be solution oriented. I'm looking at their feed. I'm looking at what they're saying, seeing what they're saying about these economic times, and none of them, other than Grant Cardone, and Grant Cardone's just trying to sell you something when he does it, are talking about it. And Grant's not trying to pump fear in the marketplace, but he is using the fear in the marketplace to try to, remind you. But it ain't going to do Grant any good to remind you that if you'd invested in Cardone Capital when you had money in the stock market, that you'd be better off. You know what I mean? He's still got to go buy inventory. I look at his portfolio. We did the interview. I'm looking at that $1,800 a month rent that he now averages, and I'm like, might have to soften. There might be a correction. There might be a contraction in the market. You got inventory in Houston, Texas, and now oil prices are going down. You know what I mean? That's going to be an immediate impact. Right. Bro, I don't know that your clientele at $1,800 a month are insulated in this environment, but I can't speculate. Time will tell. It will flush itself out, believe me. But it would take a long-term dip, and I don't know that we got that here. I don't know that it's going to be around. I don't know that it lasts 6, 7, 8 months. I think we all need to pump the brakes short term, but long term, I think overall, I think we'll be fine. But that's just me. Some of our other strategies, our strategy really doesn't change. Like Steve Glasgow said, he still employs the same strategy because he's always used it. You know what I mean? He's always been in that lower price market for rentals, and he's wholesaled anything over a certain point, and he's stuck to his fundamentals. And so fundamentally, his business isn't going to change. If there's a better buying opportunity, he'll take advantage of it. If there's not, he'll just keep doing what he's already been doing. We're kind of in the same boat. I think lenders and the availability to money. I mean, I had that conversation with the gentleman. He was asking me questions, and I'm like, you need to call whoever your in loan person is for that asset and see what they say. If they're going to be able to loan you money in 45 days at whatever interest rate, it looks like it'll work out. But it falls apart as interest rate goes up to here. And if you can't get that loan at all, then the loan you can get right now is this, and it doesn't cash flow at all. It drinks $300 a month. So if you can pay $300 a month to own that asset, and you think it's going to be a jam up asset in 10 years, and you don't want to miss that opportunity, then by all means, pay that $300 a month to own it. But if you don't think it's a great 10-year asset, and you don't want to pay $300 a month to own it, then the facts tell me that you should possibly pass on that deal, because the only thing for certain from the numbers you're telling me is it's going to take $300 a month of your W-2 income to sustain that asset. That's the only thing that it looks like for me. And that's, I underwrote this deal earlier that I raced off of here for Spoon. Our model still hadn't changed. We're not going after marginal rentals. We're going after 2% rentals. Been criticized heavily for it over the last probably 7 or 8 months. Didn't know it, but nobody ever says stuff like that to your face. They always just talk about it to somebody else. Like, you know what I mean? But
exactly.
Apparently rule investing is a shit asset class. And I'm like, I don't know, man. We still got toilet paper and hand sanitizer out here, bro. Like,
we have $50 generals. What do you guys have? What's going on?
Yeah, like we're good. So what else? Any other advice? Where can people find you if they wanted to get a loan? Can you write them a loan right now?
Yeah, of course. So just email me, nathan@nathanloanteam.com, or just message me on Facebook. And especially like if I'm wrong about anything, just message me on Facebook and just tell me, and I'm cool with that. So I know Marshall and we had been going back and forth a little bit on Facebook, and he was of the mindset that probably stock market is going to recover pretty quickly. And I was saying, I don't know, man, like it's kind of a big hit right now. So, but we'll see. I have no idea, so it is what it is, but
it depends on how long it lasts. And it depends on your definition of quick. Quick to me is anything less than 2 years. That seems fast, like a fast recovery.
It's not even, the market is only down to,
it's not even down.
Whatever. Yeah.
It's not even down. Like that's the perspective people are missing. Somebody told me this the other day. Stuart Miller told me this yesterday while we were fishing. So stock market, when Trump takes office, I think is 18,000. Right now it's 22,000 when I looked at my phone earlier. So it's still up 4,000 points from when Trump took office in 2017. So 2017, Trump takes office. It's still up 3,000 points, but nobody thinks about it that way. Everybody thinks about it from whenever it was 28, 29, 30, whatever.
Perspective. So
right. Like, oh man, I've lost so much money. No, you're still made money. You still made money. You're just thinking you lost money. I told somebody, I was sitting at dinner with somebody and said, get your money out of the stock market right now. And I don't know if they listened or not. You know what I mean? But I told them that whenever it took its first $1,000 drink. And the only reason I told them that is because I was like, if it'll take $1,000 drink on some bullshit like this, I don't want to be involved with it. Like, I can't deal with it right now. Get it out, set it to the sideline. You like the stock market, and just fucking wait. Just watch it do whatever the fuck it's going to do. And, and then whenever it's all over with, whenever it's back to business as usual, everything's normalized, get it back in there. You know what I mean? And let it do whatever it's going to do then. But right now, when nobody can give you an accurate prediction and nothing is normal, it's not the time. It's not, unless you're a gambler. Now, if you're a gambler, by all means, I love you. You're my people. You're my people in the stock market. Gamble your ass off. Shove chips in, pull them out, fucking pay the taxes, carry the losses forward, whatever you want to do, baby. That's your money. You do whatever you want to do. But if you're just somebody that's got a 401k, fuck with it. Like set it off to the sideline, wait for it to normalize, get back in. Quit trying to, I know people that are just like hell with it. You don't lose money until you take it out. I guess that's
right.
You know what I mean?
Just let it sit, whatever. So
yeah, just let it sit. But if it's this, I don't know. People all the time. People all the time are always quick to speak up when everything's kind of normal. I don't see anybody right now coming to the forefront and being like, don't worry, guys, I'll lead you. Like I was hoping Grant Cardone would just take us to the promised land. He's not. He's telling us to buy Pop-Tarts. Like, fuck. I already know to buy Pop-Tarts, Grant. Like, fuck, man. I'm trying to hear some shit right now. I'm trying to learn something. Like,
yeah,
you're hearing shit we're not getting to hear. You're plugged into a stratosphere that us peons aren't plugged into. What are you hearing? You know what I mean? Like the NBA didn't make a decision to cancel the season.
Right.
You know what I mean? Like there's information that's available out there that you're not giving to us. Tell us the real deal, man. But
I feel like almost like if we just shut everything down and be like, hey guys, just stay at home for 14 days, make babies, whatever you want to do, 14 days, okay? We'll cover something, whatever. If we just did that for 14 days, everyone stops contaminating each other, whatever, spreading it, then the stock market would know. They can look and they say, okay, this X factor we have here, all of a sudden we have certainty on it. We're going to get back to being productive in 14 days, whatever. Maybe it needs to be longer. I don't even know. But right now we're uncertain, we're like, we don't know what's going on, what's going to happen, liquidity, blah.
But you can't make these fucking idiots stay home for 14 days. I've been trying to make smart people stay home for 14 days. You know what I mean? I was having to club some of the smartest people I know with like calling them like, hey, bitch, stay home. Like you don't have to be out in this. Like you don't have to. If you have to go out in this to make a living, you have to go out in this to make a living. But if you are good, stay your good ass at home. You know what I mean? Like I told DJ, if he goes to a bar, if he goes to a concert, if he goes to anything, he's now fired motherfucking DJ. Like I cannot tell you what to do with your free time, but I can fire you at any given time. You better, because DJ's got to go into our tenants' homes. You know what I mean? He's got to go into different people's homes to fix their stuff. I can't have you, going to a fucking truck show because you want to jack off on somebody's rim and then exposing grandma to some shit that might wipe grandma out. Like we don't need that juju on us. Stay at home.
Right.
So, but that's the kind of stuff that like, me, some of the habits that I've changed is I'm not eating out right now. It's like, I'm on the road all the time, but I'm not going into a restaurant and sitting down and eating. I got a can of ether. Don't ask me why. It was all they had. And I sprayed on the gas pump before I pump gas. I use my hand sanitizer when I'm done. Created some new habits to try to, expose myself. But I've got to get fuel and I've got to go check on these projects. But I don't have to get out of my car to do any of it. You know what I mean?
Yeah.
And I don't have to eat some bullshit along the way. I'll just eat whenever I get home some shit that I, can cook in my own kitchen. And I feel like I'll be good. I can still earn a living in that. We told everybody in our office to work from home. We told them stay their ass at home. Don't know if it's going to help. You know what I mean? Because you give people free time like that. Now what do they think? Oh man, I can work from the beach. To the beach they go with their kids, and their kids go play with other kids that are corona'd, and boom, the free time we gave them was their demise.
Yeah. No, yeah. I mean, like we'd probably be fine. I'm just more worried about the grandmas you were talking about and everything, and people who have other health issues, or they need more care, like people who diabetes. I heard that was kind of an issue. Older, if they smoke, that's all kind of so it's not good.
No, we're not visiting my dad at all, and I told him, it takes a little bit of personal responsibility, but I saw somebody on Facebook ain't got no money. He got 2 fucking nickels to rub together and just got the cheapest plane ticket on planet Earth and's heading to Miami. And I'm like, great plan. And that, they're going to come back to my hometown, still broke as fuck, seeing a beach with coronavirus and wipe us all. not necessarily wipe us all out, but bring it, and it's like,
Yeah,
you can't
yeah.
do nothing about that. You can't, like, that human is always going to exist. Like, and
Yeah,
so
yeah.
I'm just going to keep my distance. I'm going to, pay at the pump my fuel, pack my lunch, eat my snacks that I brought from home, and deal with my contractors on a limited basis.
Do your own stuff, so just mind your own business and go for it. So
and pump out a shit ton of content over the next 2 weeks while nobody's in this office on the YouTubes. So if you're watching
man,
and you're not
that's
subscribed,
awesome.
get on there. I'm going to be breaking down a 6-cap investment later. I'm going to be stress testing a 6-cap.
That's awesome. Yeah.
Just different things that I've been thinking about, and then pulling people like you in, because since we're all going to be at home anyways, we may as well talk on the internet about our own experiences and everything else. Because if our own experiences are based in reality, like, hey, I did see this did happen. This isn't a rumor mill. Like, this just happened to me. That information needs to get out to the public, because the rumor mill is what's killing people.
Yeah. No, that's an awesome plan. So I saw somebody tweet earlier today that Isaac Newton, he was back in like the 1600s, man. They had the bubonic plague going around his college, and so he had to stay home for like a week or so or something, right? And that's like when he invented gravity or whatever, or something, like his theory of gravity. Like, so I'm like, dang, like that dude was productive. So like, what am I gonna do for the next week? Like, I don't know, man. So
I'm the same way. I think there's going to be a whole lot of babies. I don't know what's 9 months from now, but there'll be a lot of those babies. Whatever. Yeah. And I haven't been riding my side by side enough. I haven't been fishing enough. Emery and I haven't been spending enough time on the couch watching whatever bullshit ass shows she want to watch on Netflix.
Right. A lot of productive things to do. So
I got a track hoe in the backyard that I'm trying to figure out how to get fuel to it, Corona-less fuel to it. And if I can get a fuel delivery, I might clear off a full 22 acres in 2 weeks. There's all kinds of little projects I'm going to work on in the next 2 weeks. Yeah. But overall, navigating this through tough times and making hard decisions and pulling in people's input like yours into that decision-making process, and then disseminating that information to the masses so they can calm their ass down and understand it a little better, is also a service that we can provide, because we have a platform in which to do it. So
right.
I hate that the leadership from the top isn't doing more of that. You know what I mean? I hate that people that have coined themselves as gurus and different things aren't out in front of this talking about their day-to-day experiences on what they're doing and how they're navigating it. Because one, I'm selfish. I want to know what they're doing to help me. Two, how many people would it help if we were just having real conversations about what we're actually doing, not what we think,
right.
But what am I actually doing? You know what I mean? I'm not eating out.
Yeah.
Our offers have changed to this. We're underwriting deals like this. We're not meeting face-to-face with sellers, but we are looking at the property like this. We're getting these kind of pictures, like actual operational decisions that we're making. I think more people need to be out talking about it, instead of there's a normalization that takes place where people just think, oh, well, this ain't going to affect me. And then they're talking.
It's already here, though. So
I know.
Here.
I already have coronavirus. I don't have it, but in my mind, I got it. You know what I mean?
Yeah.
I'm living my life like I got it.
Exactly. We can only control what we can control. There's no reason to be fearful. All you can do is get some sleep, just drink plenty of water. There's nothing else you can do, really. Exactly. So be as productive as you can. I'm shoving in as many mortgages as I can here, and I just talk to people on the phone. I don't ever have to meet face to face. And I'm hoping that rates will drop down to the historic lows they were at over the last 3 days. They kind of went back up, but every technical indication shows that they should be going down, at least close to where they were Monday morning. So we'll see.
So if we can be of any help, if you get any new information, want to jump on, if you just want to jump on every day for the next 2 weeks, it don't matter. Anything that we can do to help you out, let us know. And if y'all need a mortgage for your personal property, do you do much with investments?
Yeah, I do, but I try to take most of them conventional. So
Yep.
they have to fund in like your personal name, not an LLC. You can move it to an LLC afterwards. If you're purchasing it, you need at least 15% down, but I really recommend like 25% down because there's huge pricing increases if you go above 75% LTV. So if you put down 25%, you'll get a much better rate than if you put down 20% or 15%. And it's almost like it's like 0.35 discount point difference between like 80 and 85%. So it's almost like you pay an extra 0.35 just to get like another 5%, so it's a pretty big pricing increase, but that's primarily what I do. I mean, if investors want to talk about like a line of credit, and that's the thing too, is that I'm kind of in my mindset, there's a lot of other investor loans out there, DSCR, there's all these other products, right? But in my mind, I'm not certain that in 2 or 3 weeks, somebody could just pull the plug and say, oh no, we're not doing that anymore, right? Or, at least with the conventional products, those are backed by Fannie Mae, Freddie Mac, those guidelines. Like, if they change or they just pull the plug on those, we have way bigger issues to worry about than just,
True.
So that's kind of what I'm trying to focus on. But I don't know if that makes sense just personally. So.
Oh no, it makes plenty of sense. Like we're, yeah, no, I look at some of like the 30-year product that we would have, right? Mm-hmm. As we go through this training to become a hard money lender, we have a 30-year product that backs it up. And I'm like, is that product even going to be available in 40 days? Because that was all Wall Street. Mm-hmm. That was all, that's all not a hedge fund. I don't know, but that's all Wall Street money.
They have their own like underwriting. They have their own process and their own rates and everything. Yeah. So
exactly. So we originate the loan and they buy it. Are they going to be buying that paper? And it happens at closing. You know what I mean? But it's like
right.
There might be a bigger appetite for it. We don't know. You know what I mean? I don't know what it looks like. I've been trying to get somebody to explain it to me now for a couple of days. Yeah. I'm trying to get them on here to explain it. Tried to get the CFO of Homevestors whenever 2008 happened to try to get him on here. He ain't going to be able to do it for at least a week. But, I want that information because these really high-level people that have dealt with this and rode through the 2008 cycle are the people that I want to talk to during this time to provide some clarity and some different things. That's why, Grant Grant went through the 2008, 2009 cycle. There's some parallels here. Not quite the same, but there's things that are happening. Talk about it. You know what I mean? Like put it all together, sit down, talk about what you see, and how are you stress testing your portfolio? What kind of cash reserves did you keep on hand for this? Was it cash reserves or credit lines? Like,
right.
I've always wanted to know that cash reserve question, and I've never got a hard answer for anybody. And I had Grant on the horn and could have asked him, had it wrote down and didn't ask him. Like, I didn't think he would answer it. I didn't think, if I asked him, I was like, hey, how much cash reserves do you keep on hand? Is that debt? Is that money from the fund? Or is it personal cash reserves?
You've talked about like per door, you have a number that you want to keep cash reserves, right?
Yes, $1,500 per door.
Per door
has always been cash reserve and credit lines, right? This incident is going to. We have a $250,000 credit line or $250,000 worth of credit lines is the way to say that. We talked about drawing them down to a certain extent. We talked, we underwrote what it would take to draw that credit line now that we know that we still have access to it and what it would cost us from an interest perspective and if it would be worth it to have that cash on hands in case shit hits the fan. How long would that give us if, they announce tomorrow, hey, nobody has to pay rent anymore? Like, you don't have to pay rent during this crisis. We still got to pay mortgages, but they don't have to pay rent. What happens?
That's a big hit. So
it's a big hit for every landlord, no matter how big or small you are. Everybody would need the cash reserves to manage that, and it would be for us. It would be sub twos everything that we have. All that we manage for all of our partnerships, we have about $120,000 a month in mortgages. So you can do the math on how much cash reserves you would need to float that for 90 days. And, it's like, damn, we have, and you want to do what's ethical. You want to do what's right. You want to do
help
everything.
people out, as much as you can, but.
Well, but the sub twos that you took over,
Oh, right.
It's like, there's tough decisions. So it's like, what contingency plan do you put in place? How long does this last?
Mm-hmm.
What conversations can you have with lenders? If they're immediate lenders that you can call up and, they're not a bank, that's a lot better. A bank ain't going to let you skip that mortgage payment. But, your private money guy that's in this with you be like, hey, bro, they're about to fucking wipe us out because they're going to say nobody has to pay rent anymore.
Mm-hmm.
You going to work with us? Or you want this non-rent, this house that ain't paying no rent? Like, what do you want? But you don't want to have that conversation, but you have to prepare to have that conversation. So, but you don't know what the overall, like somebody said, just because they announce you don't have to pay rent doesn't mean everybody isn't going to pay rent, because, they might not say you don't have to pay rent, but they might word it at, if they say you don't have to pay rent, that's game over. It's fucking, all right, draw down the credit lines, brace for impact. But if they do say that you just can't evict, well, a lot of people are going to still pay rent because they know eventually you're going to be able to evict. You know what I mean? And they don't want to just accrue debt and then have a judgment against them. So most people will make the right decision there, but it depends on how the information that comes out,
how it's worded, So, or even if they say something like you just have to pay like 2 or 3 months over like the next 12 months or something, like that's still going to hit you pretty hard because it's an instantaneous mortgage payment for you. And then, but how many people are really going to do that, right? They might just, screw it. And you have to go put them in collections and try to get that, or
you never get it. But it just takes everybody to zero then.
Yeah.
I mean, everybody goes up to the top. I mean, it's like we're all feel like we're entitled to, you know what I mean? The tenant feels like, oh man, we're in a crisis. I'm entitled to some free rent. We're like, oh man, we're in a crisis. We're entitled to some free mortgage payments. You know what I mean? Like, it's like the homeowner's like, oh fuck, we're in a crisis. I'm entitled to not have to pay my mortgage. Like, our entitlements start taking over, but somebody has to pay the piper. The bank still has to pay employees. You know what I mean?
Mm-hmm.
They still have to service their own debt. Everybody has to, you know what I mean, do what they can do. So it's like, for me, it's trying to put that in perspective and know that, in the worst case scenario, which everybody plays out, it's what actually happens. The one thing I did a video on it the other day, we only got 13 evictions on our board. That's fabulous, right? We're still leasing units. Our vacant units are still being leased. So we're not seeing anything on the rental side of things that would alarm us. But all this happened after rent was due. Next month when rent's due, we'll see what the real impact is.
Right.
And that's, so we've got like a 30-day buffer to plan out what we're going to do, but we're also going to be very transparent with it, because I think there's a lot of people that want to know. You know what I mean? I think there's a lot of people that need to know. I think there's a lot of people that are flipping houses and stuff right now that might not realize, they might have went from, a 20 or 30-day market to a 90-day market overnight in any price point, because, people just might be hoarded up, or the interest rates went down. So like you said, there's 5 million more buyers in the market at this price point. So if you adjust into this price point, if you switch it up and go into this, $150,000, $200,000 price point, you're going to have X, days on market are going to go from 20 to 2, you don't know. And nobody can really accurately predict it. We can just take the data that's available to us and navigate it the best way we know how. But one thing I wouldn't recommend anybody doing is stopping.
You just have to keep working, keep yourself busy, and
shift, but don't stop. You know what I mean? If you were in $300,000 housing and now you're looking at it and it don't work no more, get into $100,000 housing. It's not as bushy. You know what I mean? There's it won't get you laid as often, right? You know what I mean? Like I flip mansions. I'm a mansion flipper, but it'll keep your lights on. It'll keep you going. You know what I mean? Like, you won't be as cool at the bar, but I don't want to be at the bar right now anyway. So
Right.
But
Yeah. Anyway,
Nathan, I appreciate you.
we'll talk to you, sir. So yeah, we'll stay in touch, man. How everything is going.
Some more. I'm going to be here. I'm going to have 150,000 hours of content going out. They left me
That's
in an
awesome.
office alone. Shit's going to get weird. You know,
That's awesome, though. That's
I got to
good
go
to
there,
hear. So
spray Lysol on DJ's desk. Nasty motherfucker. I don't want him getting me sick. Came into the office today. I was like, anyways, but I'll holler at you.
okay. Take care, sir. Thank you.
Yes, sir.